Looking at the US dollar index on a daily time frame, you could see that the US dollar index made a lower high, then made a lower low and a lower high and a lower low and a lower high, meaning bearish momentum. While at this exact same time, Australian dollar US dollar made a low and a lower low. If it was perfectly in sync with the US dollar index, it should have made a higher low up here. But instead it made a lower low. So in a perfectly in sync world, Australian dollar, US dollar should have done this. Because if they're inversely correlated, it should have had the exact same price movement as the US dollar index. But the US dollar index showed you where Australian dollar, US dollar should have been. It should have been right here, but it didn't. US dollar index continued down and then Aussie dollar caught up. So this area right here, any one of these daily candlesticks you could have gotten in on and taken a monstrous long position. This divergence right here, when comparing whatever Forex pair you're looking at in correlation to the US dollar index, when you find divergences in between those two, that is the smart money technique. The smart money technique is simply using divergences to get into a nice, good trade setup. Okay, so now that you have a general understanding of a majority of ICT's concepts, what I want to do is jump into the charts and show you specific examples of these and how price moves and how to get your bias from the higher time frame down to the lower time frame, then use the lower time frame for your entries. So I'm going to run through a bunch of examples of breaker blocks, of order blocks, fair value gaps, liquidity voids. I'm going to talk about the Judas swings, turtle soup, silver bullets, the hours that you should be trading. So this section is going to be a little bit heavier, and I am going to cherry pick examples because you need to know exactly what these setups look like. Because if these setups don't happen in the required parameters, the time frames that you're trading, for example, the London kill zone or the New York kill zone, you do not trade that day. So if you don't see the setup in the kill zone, you don't trade. So yes, you have to cherry pick. Because yes, when you're looking at trade entries, you want your optimal trading entry. You want all of your check boxes to be ticked. If you don't see the setup at that time, you don't take the trade. That's why you're not going to trade every day using these ICT concepts. But when you do trade, you will have a higher likelihood of having your trade play out. All right, let's start getting into the nitty gritty of it. We are now in Trading View. I'm going to run through every single thing that we covered in the course so that you can see what it actually looks like on the chart and how I would analyze all of this looking at price now that you have all of this ICT knowledge. Now, when we talk about elements to a trade setup, and that price only does one of four things. Price either consolidates, which you can see here in very flat price movement. Price then has expansion only after a period of consolidation. After an expansion, price will then have a retracement. After a retracement, again, it can go into a period of expansion. Only after a period of expansion can price have a retracement. Price repeats this pattern day in and day out every single day. So if you're ever in a period of consolidation, you must only be expecting a period of expansion. During a period of expansion, you can either expect a retracement or a reversal. So if you are in an expansion phase, either look for price to reverse or retrace and continue its expansion. There is an order of operations in the way that price moves. Price will consolidate, price will expand, price will retrace, price will expand, price will retrace, and so on and so forth till the end of time. Now, when doing top-down analysis, you want to start on a high time frame. Right now, we are looking at a weekly chart, taking the highs and lows into consideration and areas where liquidity lives. Looking at the current price range, you are not concerned with this stuff over here because this is the price range that we are living in. This is the current high and the current low on a weekly time frame. So this is the only thing you should concern yourself with. If it breaks below this range, then you can start looking over here. Once you've done that, you can take it down to the daily time frame. Each one of these candles is 1 day long. At this point is where you can create your bias. We were on a downtrend on the daily, but after a short period of consolidation, we are now in an expansion phase to the upside. So our overall daily bias is bullish. Then taking it down even further to the 1 hour time frame, you can see this is our current 1 hour chart looking at our daily bias to the upside, breaking through these key levels on the weekly chart. All of these key levels are areas that you need to really look out for as either rejection areas or price targets. But now that you're on the hourly chart, what I would like for you to do is mark up every single midnight hour, meaning the start or midnight of every single day. Now, I know ICT is against indicators, but I'm not drawing up a bunch of lines. If you type in New York midnight into the indicators, click that button, you will see midnight lines for every single day. Change the settings, make them white, and give them way more opacity. Now, zooming in even closer, you can see every single day perfectly separated by these midnight lines. At this point, what you can do is start marking up the daily highs and daily lows of each day. Once you do this, you will have a clear indication of the trading range. And once the new day starts trading, you can see on an hourly chart where is the next closest liquidity. Above every single daily highs and lows lives a bunch of liquidity. So as you can see in this scenario, price shot up, grabbed the liquidity, and then started going down. Then the next day's high was broken with the next day's high and cascaded down. At this point, you can start seeing where all of these traps are, how market moves on a daily basis, and what you should be expecting. And because you have an overall bias to the upside, you can have a clearer indication once you get into a smaller time frame, looking at New York kill zones, London kill zones, the market manipulation, the power of three, all of the things that we're going to discuss later on in this course. This is how you should be breaking your charts down. Start with the weekly, move down to the daily, then to the hourly. Then you're going to be looking for your entries on the 15, the 5, and even the 1 minute. Or if you want to stick to a higher time frame, you can leave it just like this. Now, because we have a clear understanding of higher time frame analysis, what we can now do is recognizing when we see impulsive moves to the upside. This is clearly an impulsive move to the upside, and our bias is bullish because on a higher time frame, we know where price is headed overall. So looking at this entire swing from top to bottom and marking the halfway point of this range, we can now see the bullish momentum and also understand that this is an area where the price is at a premium, and this is an area where price is discounted. So if price had a huge impulsement movement up and then came down to a discounted area, you know that these are the areas where you should only be looking for buy opportunities. And as we discussed before with fair value gaps, you can clearly see one formed right here on this big impulsive candle. And as price came down into a discounted area, this was your buying opportunity. The same would go if our bias was bearish. Let's just say, for example, that we are bearish. We had a large liquidity sweep right here. So the top of this range is a premium. We had a huge bearish movement down. Price came back up into an area of premium, and we do have a bearish bias, so we're only going to get into short positions once it's in the premium area. And because we've already learned about liquidity voids, we know that right here, this is an area that is imbalanced, and once it gets into this area and starts rejecting off, we know that this is our area where we want to get in. All right, and now what we can do is start talking about fair valuation. I'm going to show you multiple examples of fair value gaps, volume imbalances, rejection blocks, breaker blocks, all of that stuff. But I always want you to keep in mind the higher time frame analysis that you did. Remember those two lines that were really close to each other when we were looking at the daily separations? This was the low point of this day. This is the midnight line. When the next day opened, it came down here and grabbed liquidity and just left, taking the liquidity below the previous day's low and skyrocketing to the upside. Now, because you're familiar with market structure, you know that price makes lower lows and lower highs when it's in a downtrend. Even this was a lower high. This was a lower low. This right here was the area where market structure was broken. When that happened, because it was so aggressive, price left a fair value gap between this candle and this candle. So let's zoom in and look at that. The top of this wick and the bottom of this wick is now your fair value gap. As price continued its price movement up, continuing to break the previous market structure, it retraced down into this fair value gap and rejected up. These fair value gaps are areas where you can place limit orders. You get tapped in, really tight risk to reward, and at this point you're targeting previous highs and market structure to the left. But you can see if you targeted just a movement up to that previous swing high, you had a 1 to 4. And because we already learned about high resistance and low resistance liquidity sweeps, we know that liquidity lives above this area and we have a bullish bias. So if we target just that same high, assuming that price wants to take that liquidity out, because we have a bullish bias, we can see that over time, you got a 1 to 29 risk to reward ratio on a 15-minute chart. Because you have a clear understanding of higher time frame analysis, liquidity grabs, and fair value gaps, as well as low resistance liquidity. So price made a fair value gap, came down to reject it, breaking above this zone, above this previous high, then coming down in a small retracement right here. This small retracement can also be seen as an order block. Price came down in to touch it, continued up. Now you're probably asking yourself, why did it reject right here? Looking left and what we just learned about order blocks right here, we can see another valid order block right here. Price wanting to sweep liquidity and push down. But because our overall bias is bullish, price came up to try to sweep liquidity from above this area, trying to rebalance the prices here, but always keeping in mind this liquidity void right here where we had aggressive price movement, where price is imbalanced, and always keeping in mind that price wants to rebalance. So it tried to take some liquidity from above this order block, rejected down, but was unsatisfied with the liquidity void right here. So the following day, it filled up that entire liquidity void, then grabbed some liquidity from above that previous swing high and then cascaded down. But because our bias is bullish and nothing has shown us otherwise yet, we want to continue to buy in areas of discount at fair value gaps. Fair value gap, buying in an area of discount, not in an area of premium. Now you're probably wondering, if you always have a bullish bias because the higher time frame shows you that that's your bias, how did we get a huge move down like this that created this liquidity void, that created all these order blocks along the way? What I want you to do is always keep in mind that when price has huge spikes like this, right? All of this area needs to be covered by selling orders. Price wants to be balanced between buying and selling. So price was buying for a while. 3 days, 1 day, 2 days, 3 days. Very, very bullish for 3 days. Price then consolidated for an entire day, grabbed liquidity, and then looked for liquidity lower to rebalance all of that positive price action right here. And looking at areas of consolidation, which are usually areas of support and resistance, you can see that it was respected right here, grabbing some more liquidity to be satisfied, and then taking off in the bullish bias that you were looking for earlier. This was a run for liquidity. This was a run for liquidity. This was a run for liquidity. Every single one of these daily highs and lows is an opportunity for a run for liquidity. It can either be a low resistance liquidity run like we had right here, because there was no market structure to be seen in this area, just small, short order block retracements, versus areas like this where there's a lot of market structure, higher highs and higher lows all the way up. So when price wants to grab liquidity, it suffers a lot because it's coming in contact with all of these areas where price had resistance and broke support, continuations, all of that. High resistance, low resistance. Now, what I want to do is talk about those retail day trading traps. Remember how I told you they don't happen that often, but when they do, it's usually at a previous level of support and resistance? And the market manipulators and market makers and banks and financial institutions always want to take the retail day traders' money. So, looking at a flag pattern, huge flag pull, flag pattern. Most of the retail day traders are trying to get a continuation of the flag pull out of the range. They get into a long position. It taps liquidity above a previous day's high and cascades down. Look for these patterns that you're used to trading as continuations, and keep in mind previous days highs and lows, and it'll keep you out of a lot of trouble and might actually get you into a really good trade knowing that this is happening at this area. So this is the only flag pattern that you should really be looking out for as a trap. All right, so you remember when we talked about trading days of the week? This is the entire week laid out for you guys. It doesn't happen every day, but like I don't like Monday. There's a lot of whipsawing back and forth, or it stays in a tight consolidation range. He said Tuesday, Wednesday, and Thursdays were good days to trade. This Tuesday, unfortunately, was pretty much flat all day, but Wednesday was a good day. Huge long move, liquidity sweep, and you could have made a decent amount of money in this nice move right here, knowing previous levels of support. And then Thursday's also a good day. And remember, he said Thursdays could also be reversal days. And then Friday is not a great day to trade because it's pretty much a setup or a trap for the following week. So as you can see, we had this huge bearish movement down, making people think, oh, it was another liquidity sweep. We're going to keep going down. Monday opens up, and what did it do? Screwed you over from your thoughts on Friday, didn't it? Now, let's take a look at an example of a breaker block. This one is perfect right here. We had a nice price swing up, making a higher high, a lower high, higher high, and then breaking structure. Once that structure was broken from right here, what was the previous down move before that high point? Right there. That is your breaker block. What did price do when it came back up into that area? Rejected immediately, going down and creating the day's low. And if you want to see what that looks like on the other side, it's right there. Just inverting the scales. Price was making lower lows, lower highs, broke down, broke structure, came back. What was the previous swing up after the daily low? Broke structure, rejected, boom. Okay, now what I want to do is focus on today's price movement, because today's price movement for me was really, really nice. The market was trending very nicely in the London session on NASDAQ. So let's take a look at it. Market structure was bearish, broke structure right here, and you can see every time it made a pullback and a break above. Candle had a pullback, break above. Had a pullback, break above. Had a pullback, way hard break above. Came back down, retested. I could clearly see bullish momentum going on. I was not trading at this time, but I saw this price when I got on the charts this morning, so I knew that we were going to have a bullish day. This green area was London session. Small fake out at the beginning of the session, breaking market structure, breaker block, rejecting off of it, and every single one of these pullbacks, breakout, retest. Continuation, pull back, retest. Kept going up and up and up. Every single one of these breaks of a pullback came back to retest until it broke structure. And by that time, you should be done trading the London session, because at 11 o'clock, it usually starts reversing. And if we look at it, last move down, push up, broke structure, came back to retest, push down, double bottom. And what did we learn about rejection blocks? If they test and reject, it's a great trade. What's our overall bias? Bullish. Why did price reject right here and not try to sweep the liquidity right here? Because this right here is a breaker block. Dragging it out, boom. Having an understanding of all of the breaker blocks, of all of the order blocks, of all of the fair value gaps, of all of the PD arrays, all of the things, all of the confluences at all times is going to help you with your targets, getting out of trades, catching reversals, catching continuations, finding areas where price is likely to consolidate. All of these things you need to have in your head so that you don't get blindsided when price does something that you didn't expect. Because if you know where all the order blocks are and it breaks through the one that you had marked up, look for the next one lower. You're going to have losing trades. This is not something that you can do every single day and win every single time. But if you know what breaker blocks look like, what order blocks look like, where these fair value gaps are, you're going to be more successful. All right, now let's get into some kill zones. There are multiple kill zones. ICT teaches time ranges. There are London Open kill zones, New York Open kill zones, lunchtime kill zones. There's a huge mixed school of thoughts on this. But usually it's just a 3-hour window. This is New York time, so UTC -4, London 2 a.m. to 5 a.m., New York 7 a.m. to 10 a.m. So if we look right here, this is 2 a.m. to 5 a.m. What do we see right here? We see the midnight line right here. This is where price opened. So that's the daily open. We see a swing up, a liquidity sweep, a break below the daily open, a rejection off of it. And what do we look for after a rejection of the daily open? This whole swing down right here is a Judas swing. The Judas sheep goes away and the market moves in its intended direction of the original breakout of that previous swing. Very heavily, I may add. Very heavily. The Judas swing during a kill zone area is like kind of being able to print money. If you can identify it and know where the kill zone is, as well as identify a Judas swing, once we break back up into that range, you're good to go. But where are you getting in? That's when you look at your other PD arrays. We had that strong aggressive rejection up, right? We can look for breaks of a retracement as an area where we can consider it an order block to get into a long position. You had 0 drawdown on that entry. And what are you targeting? Previous day's high, as well as the liquidity. Now let's look at the New York kill zone. 7 a.m. to 9 a.m., nothing happened here. Not every day will something happen in a kill zone. It is just an area where things are most likely. Probably because something happened in the kill zone for London session. But if we look at the previous day, 7 a.m. to 9 a.m. New York time, you can see price jumped into a fair value gap and just skyrocketed up. All right, so now what I want to do is talk about the silver bullet setup. This is the smallest trading window. It's only 1 hour during London session and 1 hour during New York session. What you're doing is looking for an area where price has rejected, aggressively made a fair value gap, and came back into that zone of the fair value gap to retest and continue. Again, this doesn't happen every day, so we need to look for specific examples. All right, so here's that previous example that we looked at where we see this fat fair value gap right here, and this is exactly between 3 and 4 a.m. Price came back into this area to retest this fair value gap, and it just took off. This is a perfect silver bullet setup. Huge rejection, break of market structure, come back in. During that break of market structure, the move was so intense that it created that fair value gap. Price came back in, retested, boom. Easy, simple silver bullet setup. Again, it does not happen every day, but when it does, it's going to happen during this time. If it does happen during this time, take the dang trade. All right, so here's an example of the New York silver bullet setup. This is the previous example that we looked at where we had that huge breaker block. Once we rejected off of that breaker block during this aggressive movement, we formed a small fair value gap right here. Between 12 o'clock right here, actually on the candle where the fair value gap was created, and 12:55 when the candle came into that fair value gap and rejected down. Quick and easy silver bullet setup, and your stop losses on these things are seriously tight. Even if you're just targeting the previous swing, you're getting 1 to 7s. This is on a 5-minute chart. Okay, so now what I want to do is discuss the power of 3. The power of 3's basic concept is that if you are looking at a higher time frame, this right here is the daily chart. When this candle opened right here, the price went down in confluence with these 3 bearish candles. Price continued to go down and then shot up. This wick right here is the manipulation phase of the power of 3. Accumulating some orders, manipulating people, distributing price in an expansion up. This right here is what that daily candle looks like on an hourly chart. Our previous daily low was right here. And this was the previous daily high. Market opened up and screwed people over in a nice quick liquidity sweep right away. Then price just expanded from there. a little bit of distribution, balancing out the market from this candle right here, and then a continuation to the upside. This is the power of three. If you understand the power of three and you know what phase of the market we're in and you see something like this, and because, again, keeping in mind that our overall bias of the market at this time is bullish. Quick liquidity sweep, bullish movement up. If you can get into a trade during that manipulation phase in the right direction, you can hold the trade all day, the entire day, because you know that you got in on the low of the day. And then once the day is about to close, then you can get out knowing that it was going to be a bullish candle. All right, so what we've discussed so far in this video is simply talking about the current price action of this asset that we're on right now. This is the current price that it's at right now. So I gave you whole top-down analysis from the higher time frame all the way down to what we're looking at right now. This is the hourly chart, and you can see it separated by days. I've already discussed all the PD arrays, all the fair value gaps, everything. That when you have a bullish bias, you only want to be buying in areas of discount. But if you're going to be hopping down to a lower time frame, all right, so I saved this for the very end of this video because I didn't want you to simply rely on this tool. But essentially, when ICT is looking for his trade entries, not only is he looking for the fair value gaps and all the PD arrays, he's looking for areas where price is retraced to what he calls his optimal trade entry. To measure his optimal trade entry, what he's doing is putting on a Fibonacci tool onto the charts. After this monstrous liquidity void right here, you know that we're having very, very, very strong bearish momentum. So when price came back up and confirmed that liquidity void, what we can start doing is using a Fibonacci tool for every single entry on the way down. You can get multiple scalps on this constantly. So wherever our impulse started from and then starts going the other way, we draw our Fibonacci tool. These are the settings that he uses: 0.1, 0.62, 0.705, 0.79, and then fib extensions, negative 0.62, negative 0.27, and negative 1. The 705 is his ideal optimal trade entry. So first impulse swing down, retracement up, didn't get an entry from the optimal trade entry zone. Now this one, after the impulse, retraced into the optimal trade entry. If you get in at these levels, you know where your take profits are. Getting a 1 to 1.5, a 1 to 2, or a 1 to 3.5, depending on which entry you want to get. The lower down in this range, the higher your risk to reward. This is your first price target, second price target, third price target, and fourth price target. Then if you're confident in the trend continuation, you just measure every single impulse. This one retraced to an optimal trade entry, get another trade in. This one didn't. Price continued, went a little bit above the optimal trade entry, but you didn't get stopped out. Price continued. The next impulse, optimal trade entry. The next impulse, optimal trade entry. The next impulse, nothing happened. You didn't get in because you didn't get into your optimal trade entry area. Price went into consolidation because the day was pretty much over. At this time, everybody ended their workday, and now you're falling into Asian range consolidation. But the power of the optimal trade entry is optimal trade entry on an order block. False flag breakout and rejection and a liquidity grab. Price came back in, optimal trade entry. Price had a massive impulsive movement to the upside, optimal trade entry. Price rejected that previous day's opening price, optimal trade entry. It's day in and day out. Every single major retracement, a very high percentage of every single retracement is going to retrace in the optimal trade entry. So that's pretty much it. Being aware of higher time frames. What is your overall bias? What are the daily highs and lows? Where does the liquidity live? Where is it sweeping the liquidity? Where is the Judas swing? Where is it sweeping liquidity? Where are the fair value gaps? What are the London and New York kill zones? Where can you score a silver bullet on a fair value gap? Do you know how to identify a Judas swing? If it happens and you see it, the results speak for themselves. Setting up your Fibonacci tool for optimal trade entries. Understanding the market from a higher time frame, as well as the macroeconomics that he teaches. You're not going to get trade entries every single day, but when you do, they're going to be in confined time frames that I've discussed in this video, and they're not going to win every single time. But if you stay strict to the rules, and just consistently do it over time, you are playing on the side of the banks. You are aware of the manipulation that they instill in the market. And once you see and identify that manipulation, you can ride their coattails and take advantage of the rest of the liquidity in the market. Trading on the side of the banks is the intelligent thing. That's why they call it the smart money. All right, congratulations. This was a doozy of a course to create and for you guys to learn. You may need to watch this course multiple times to get these concepts embedded into your brain. If you really want to trade ICT concepts, you need to memorize this information. You need to have, at the beginning, printed out slides to see what these setups look like, to look at the current market conditions when you're demo trading and really be able to visually see, okay, this is similar to this slide that I've printed out. And another thing that I want you to keep in mind is that you do not need to incorporate every single aspect of ICT's teachings into your trading strategy. For example, you could only trade the London or New York kill zones. You can use that in conjunction with a silver bullet and looking for silver bullet setups in those kill zones, or a fair value gap entry, or an order block. So you only really need one or two of these concepts and stick to it every single day. If you don't see the setup in your trading window, you don't trade that day. You don't need to know everything. You just need to cherry pick what works best for you, what makes the most sense for you and why, and enter those trades on those days only. I'd really like to know your feedback on this course. Let me know if you liked it or if you'd like to learn some additional information on ICT, which I didn't cover in this course. Let me know or let any of the staff know in general chat, and we'll work on making this course better for you guys over time. Thank you so much, and we will see you in the next lessons.